Thank you for joining us. In this session, we'll be providing a Q2 2024 markets update and an overview of the economic outlook for US expats. Please note that the webinar is for informational purposes only. It is not intended to offer advice or guidance on legal, tax, or investment matters. Such advice can only be given with full understanding of a person's specific situation. So let's meet our expert panelists. Tom Zachystal is Chief Investment Manager at International Asset Management, IAM, a US registered investment advisor specializing in discretionary investment management for Americans living abroad. Tom has an MBA in global management from Thunderbird University in Glendale, Arizona, and holds the Chartered Financial Analyst CFA credential, as well as being a certified financial planner. Tom lives in the San Francisco Bay Area, having previously lived overseas in several different countries. He's been providing investment advisory services to American expats for over 20 years. Shane Clark is president and co-founder of EuroAmerican Financial Advisors, EAFA. Shane holds the European Financial Planner designation and specializes in financial advice and investment management for Americans living in Europe. With over 10 years of experience in international financial markets, Shane designs balanced and diversified global portfolios for long-term returns. Shane has been an expat for 15 years and holds an MSc in financial economics and an MPhil in economics from the University of Strathclyde in Scotland. He resides in Spain. If you'd like to schedule a consultation to discuss your personal financial planning or investments, go to EuroUSAFA.com or IAMadvisors.com. Okay, let's get started. Over to you, Tom.
Okay, so I'm going to share my screen here and get this going. There we go. So everybody can see that, hopefully. And yeah, let's just kind of start with a little bit of a more detailed info to follow up on what Hugo said there. So IAM is the firm I run, International Asset Management, and we are a U.S. registered investment advisor based in the San Francisco area and specializing in investment management and financial planning services for U.S. expats for over 20 years. What's different about our firm from other U.S. firms is that 90% of our clients are Americans living outside the USA, and we have clients in about 35 countries. And so the relationship between the two firms, we started EAFI, EuroAmerican Financial Advisors, Shane and I together. We started this a few years ago. We got our license a couple of years ago, and we really founded the firm to better serve our clients in Europe. So Shane is based in Sevilla, Spain, and EAFI is licensed under European regulations to do business in most European countries. And if you live in Europe, this is an important consideration and something you should ask any firm that you're considering doing business with on the investment management on financial planning side. Are they actually licensed in Europe? Because in order to give investment advice on European soil, or in fact, in order to do webinars like this or seminars, you need to be licensed in Europe. Just like in the US, if you want to deliver those services in the US, you need to be licensed there. So that's the relationship between the two firms. IAM, the US firm, does the investment management and holds the relationship with our custodial firms, Charles Schwab and Interactive Brokers, where our clients' money is held. And EAFI has the European license and gives investment advice in Europe. So let's move into the presentation, actually. So let's talk about what investment returns have looked like year to date. And there's a lot of kind of scraggles on this chart, but the major part is in the top left corner, and we can see that the S&P 500, the US stock market, is up about 16% year to date. And remarkably, what has also done well is gold. Gold's up about the same amount as the S&P 500. And then there's sort of a second category in terms of return of investment markets with non-US stock markets and emerging markets up about 7% year to date in US dollar terms. And then you have sort of the bottom category where bonds are living currently, and also real estate investment trusts. And so one question is, why this outperformance, not just this year, but over quite a while now of the US stock market compared to other investment markets like European and stock markets or even emerging market stock markets. Why this outperformance? And a lot of it has to do with what we've been reading about in the press, in the financial press, which is this allocation to technology. You know, the big technology firms driving the US stock market. And in fact, the S&P 500 has a 33% allocation to technology, which is a lot bigger than, say, an exchange traded fund in Europe, which has a much lower technology aspect to it, and the same with the UK market. And then the other thing to kind of note here is the underperformance of real estate investment trusts for quite a while. And it's interesting to know what a REIT is, because a REIT is actually a structure. It's not necessarily about real estate. For example, we hold a company called Iron Mountain, which is structured as a REIT, but what they actually do is they store data for other companies. And it's done pretty well, but a lot of these REITs that are in, say, the commercial real estate space right now are pretty challenged as you know, people are going to malls less and less, they're shopping online more, that kind of a thing. So there's different types of REITs. Some are commercial real estate, but you can have REITs that also have to do with data centers, with storage areas, with seniors residences. So it's important that you pick and choose REITs. And in fact, one of the reasons for buying REITs is for the dividend yield. But the dividend yield on this real estate investment fund here is really only about 2.5% right now, 2.75%. So you're better off picking individual REITs rather than the index right now, which is what we do. And so moving along, let's have a look at this outperformance of the US stock market. And what everyone is talking about now is the Magnificent Seven, right? So here we have the Magnificent Seven, and we also look at sort of the Magnificent Three, which is Google, Microsoft, and NVIDIA right now. And we can see that if we look at just the market year to date, the Magnificent Three are up almost 50%, right? That's NVIDIA, Google, and Microsoft. And the Magnificent Seven, which also includes those three, but it also includes Amazon and Facebook and Tesla. So when we look at all those together, those are up about 31%, whereas the US market is only up about 15 as a whole. So you can really see the influence these technology companies have on the market. And if we look at the bottom line, the red line, well, that's the other 493 firms that are in the S&P 500, the S&P 500 being an index of 500 US large caps. And it's only up 7%. So you can really see what's driving this market and what's been driving it for a while. And so the other thing we can look at is different styles. So you have, like, for example, a growth investment style, which is more companies that include technology, but other growth-oriented companies you buy because they're growing quickly, as compared to value companies, which you might buy for the dividends. You know, those are companies like a lot of the big pharmaceuticals, Pfizer and Merck would be value companies, or something like AT&T and Verizon would be value companies. You buy them for the dividends. You don't really expect the stock price to go up that fast, although of course you're hoping it will. And you can see the difference between the Russell 1000 growth index on the top, which is a large cap US growth stocks, up about 8%. And this is over the last quarter. Everything else was down, actually. I mean, when you look at the two value indices, the Russell 2000 small cap stocks, so small cap growth, small cap value, all down. Just the large US growth companies led by these technology shares over the last quarter, you can especially see this big difference. And so if I could, there we go. And so, yeah, let's look at these Magnificent Seven then. And you know, why wouldn't everybody just put all their money into them, right? If they're doing so well. Well, so here is 2023. And look how much these stocks went up in 2023. I mean, the top performer there was Meta, which is Facebook, right? Up 194% that year. Tesla was up 100%. But this was 2023. And then let's look at, and the S&P, by the way, so the S&P 500 was up 24%. So big difference between these technology companies and the S&P 500 in 2023. But what about the year before, 2022, right? And here the S&P was down about 19%. But now you've got these companies. Tesla was down 65%. Facebook was down 64%. This was 2022. So you've got a big volatility swing in these technology companies. And, you know, they've gone up a lot this year. So you need to think about this if you have a lot of money invested in these companies. You need to be aware. You either need to live with the ups and downs, or market timing is a very, very difficult thing to do. So you either need to live with the ups and downs, or these should be just a part of your portfolio if you don't want this kind of volatility. The other thing that's kind of interesting these days are emerging markets. So emerging markets obviously are a lot of countries that are sort of less developed, obviously. And one of the interesting things that we've had some money in Turkey here for the last little while. It's done really well. Not a big market, but since the beginning of the year, it's up 30%. You know, we see Taiwan and India up there in the 15 to 20% range. But a lot of the emerging markets haven't done that well. China hasn't done well compared to the US market or even European. And then some of the other ones that you might think are doing well, because you hear about you know, more and more business coming out of places like Vietnam and Thailand and Indonesia and Mexico, you'd think would be doing well, but the US economy doing well, but they're all down this year. Some are down substantially. And so why is that? There's three things to consider when it comes to emerging markets. One is the economy and the politics in that country. The second one is the index composition, because these are exchange traded funds. So there's underlying securities in that are sometimes sometimes there's a high allocation to one kind of space. Like, for example, in you know, in a place like Taiwan, 20% of the market of this index is going to be in Taiwan Semiconductor, and a 65% allocation to technology in Taiwan. In Indonesia, the banks make up 50% of the index. And most people, if they're going to invest in emerging markets, either they buy just a general emerging market fund, which, by the way, the general emerging market fund has a 25% allocation to technology. So that's just a bit less than the US market. And so that's why it's done reasonably well this year too. So people will either buy that emerging market fund, or maybe they'll buy these country funds that you can buy as well. So you need to think about, though, first of all, economy, politics, secondly, index composition, and finally, the currency effects, because don't forget, this is going to be translated into US dollar or whatever your currency of choice is. And there's underlying currency effects to this, because these aren't hedged funds. They're not currency hedged. So, for example, in a place like Turkey or India, you're kind of betting on what's going on in the country. In Turkey, there's economic reforms. In India, the whole country is growing. You know, many people say India is the new China. But like I said, in Taiwan and Indonesia, it's more about the composition of the index. And even in some developed markets, like for example, the New Zealand exchange traded fund, well, a quarter of that ETF is in a company that's related to you know, making sleep apnea cures, a medical device company. And another quarter is in the Auckland Airport Authority. So 50% in two companies for the New Zealand exchange traded fund. And then finally, the currency effects have a difference. So one of the reasons why the Thailand market hasn't done well is because the Thai baht has dropped 6% versus the dollar. So you got to make up 6% on the currency side to overcome just that. You have to make up 6% on the investment side. So there are some important considerations when talking about emerging markets, and it gets a little more complicated. But those are the kind of things to look for when investing in emerging markets. But I think it's a good place to be right now in general, but probably better to pick specific country funds rather than the broad index, I would say. So the other thing is, when the market's up a lot in the first half of the year, we start thinking about, well, what's going to happen next? Is it going to keep going up? You know, is there going to be sort of a reversion to the mean, where the second half is worse than where the second half is maybe a downturn to balance things out? So this slide, and I got to explain it a little bit. But it looks at exactly that. First half performance versus second half performance going back 40 years. And so if you look at the bottom ribbon here, the black part with the ranges, 0 to 5%, 5 to 10% if you're going off to the right and so on. That is the first half performance of a portfolio of investments, which is 60% US stocks, 40% US bonds. So it's a portfolio. It's not the stock market. And so that kind of a portfolio has had a return of, it's probably going to be in the high 5 to 10% range or the low 10%, 10 to 15% range so far this year, in the first half of this year. So we're looking at the second or third column from the right there right now. And the green numbers are what happens in the second half of the year. If they're green, then the second half of the year has been positive. If they're red, it's been negative. So if you look at the columns on the right, the ones where there have been positive returns in the first half of the year, you can see that at least the three columns to the right, the 5 to 10% range and higher, are all green, except for 1987, where we had a stock market crash in October. And so that's an indication that when you have good market returns in the first half of the year, it tends to at least persist for another 6 months. Because if you look at the other side, you see much more red there. So if you have lower market returns the first half, those are a little more persistent as well. I mean, in general, markets go up, but they tend to be a little more persistent. So we shouldn't be scared. The takeaway is we shouldn't be scared just because the market has done well in the first half. Because of what we see here, it tends to do better in the second half as well when we see that. And so then I want to talk about one other thing, which is bonds. Bonds are maybe not the most exciting thing. What people tend to do is they look at the stock side of the portfolio and then they have money in bonds and that's it, right? But bonds are going to be pretty exciting here. They've already been exciting because interest rates went from 0 to 5% in the US, and they went up in places like Europe, the UK, many other places as well. And so when you're at 0%, you don't want to be buying bonds because, for one thing, you get paid no interest. And secondly, bond prices go down when interest rates go up. But now that we're up there a little bit on the interest rate cycle, and some people are thinking more likely to go down in interest rates than up in the future, at least we're very close to stability, I would say. Now that we're at that point, bonds are a lot more exciting. And they're exciting because they're cheap. I mean, if you look at bond funds, especially. So at the top, we have the returns over really, what is it, since 2008 here, on various types of bond funds. So the really volatile purple line is the long-dated Treasury bond fund, the U.S. long-dated Treasury bond. So these are bonds that are out 20 years, government bonds out 20 years. And it's very volatile because the longer the bond, the longer to maturity, the more volatile the price of the bonds. Second, but we also see an emerging market bond fund. And so that's down actually 12% over this time period. The other bonds have done, they're all around 0%. You have short-dated bonds, which is the blue line, and the green line is what we call the aggregate bond index in the U.S., which is kind of a composite of all the bond markets in the U.S., Treasury, corporate, so on. And so if you look at this, because here we're looking at the price side on top, the price of this exchange-traded fund that holds all these bonds. If you look at just the price side, you say, well, emerging market bonds have done so much worse, right? But look at the bottom graph. And there you see that the emerging market bond fund is actually up 95% on a total return basis. That means counting interest rate payments, counting dividend payments from the exchange traded fund. It's actually up a lot more even than the long-dated bonds, long-dated Treasury bonds. So that's quite a different from the top graph. So you can't just look at the prices of these bond ETFs. You have to consider the total return, including interest rates. And the reason the difference is because the emerging market bond fund has a very steady yield. It's in the 5 to 6% range, probably around 5%, but it's very steady. Whereas something like the 20-year Treasury bond fund has a very variable yield. It's gone from 6% 2%, in dividends down to 1.5% when interest rates were zero. It's quite variable. And so over time, the total return has been much less. So it's important to keep that in mind. And the other thing to keep in mind is the maturity of the bonds. The longer the bond, the more volatile this bond index is going to be. And in fact, the long-dated bond index, this purple line, has got the volatility of the stock market. It's over twice as volatile as the green line, which is the aggregate bond index, the average of the bond index. And it's even more volatile than the emerging bond index. You know, you'd think of emerging markets as being more volatile, but in fact, they have about 1.5 times the volatility of the aggregate bond index, and the long dated bonds have over 2 times. And so, with that in mind, that's really what I wanted to talk about: bonds, emerging markets, the U.S. stock market. And now I'm going to pass it over to Shane.
Thanks, Tom. Well, since I am based in Europe, I want to focus on the EU markets. Get my screen shared here. So before I jump into my presentation, I want to talk a little bit about kind of what separates us as a firm and what we do specifically. We often get asked, what do you do? Well, we're a little bit different, as Tom explained at the beginning, in that we focus here with the Spanish company on cross-border investment advice for Americans who are either moving to the EU or have lived here for a while, and they want to have specific investment advice with those constraints in mind. So we help you structure your investment portfolio, we optimize your tax situation, and we try to get the maximum return we can given your level of risk. And something that we do as a firm is we coordinate with your other financial professionals. So to do that, we need to have a relationship with your US tax preparer, as well, in this case, as with your Spanish tax preparer. And we try to optimize your financial portfolio given the constraints in your country of tax residence with the US as well. And how we do this is, being based in the EU, working in specific different countries, we've developed some beneficial knowledge and seen a lot of different scenarios over the years that kind of help prepare clients for surprises. So one example is, say you have a house, what do you do with it before or after you move to Spain, for example? If you have a house in the US, would you want to sell it before you move and become a tax resident in Spain or after you move? That's a common question. What do I do with real estate? So we found that if you sell your house before you become a tax resident, typically you're not going to be subject to capital gains in Spain, which is a big cost saving. So these are the kind of things that we like to, go through with clients when they first come on board. We go through a client checklist to kind of avoid nasty tax surprises or problems with your investment portfolio. Another one is who you can work with once you become an expat. So commonly, when you're in the US, you work with many different custodians, many different brokers. You become an expat. Some expat advisors say, well, just use a US address. It's no problem. There's some downsides with that. For example, if you live in a state tax and city tax, and you're not paying taxes in that state, but your brokerage account is producing 1099s, the state tax authority, the city tax authority might ask you what's going on with this. And there's solutions to that, but something we try to do as part of risk mitigators is avoid problems. So we work with 2 different custodians, Charles Schwab and Interactive Brokers, who are expat-friendly brokers. They're happy with you using your address over here in the EU. So with that said, we also do financial planning. And this is very important when you become an expat. Your expenses change, cost of living, lifestyle. You might have different financial goals. Maybe you want to get a beach house. Maybe you want to fund grandkids' education needs. How do you do all of that once you become an expat? So what we do is we prepare a financial plan for you. It's 3 financial statements, a balance sheet, an income statement, and a statement of cash flow. And then we try to incorporate any financial goals you have. And we project all of that through the future. Sometimes there's milestones, retirement, through retirement, and we look at different scenarios to see how comfortable you are with how much income you're going to have at different points in your life, how probable your retirement is, and how probable funding some of these other goals you might have are. So with that said, we'll jump into the presentation here. Hopefully. Okay, so in the Eurozone in the second quarter, there's been a few big driving factors. So the economies have been performing well relative to the past couple quarters. So we've had economic growth, and this is really driven by two main reasons. One, a reduction in energy costs. So inflation is starting to get under control, and then also reducing interest rates. So the two main reasons for growth over here are inflation is going down because of reduction in the energy costs. Food prices have gone down. That caused the European Central Bank to be able to lower interest rates, which has given people more money in the households, it's increased consumption, and it's led to higher growth. Companies are starting to invest more. There's been more tourism in different areas. For example, Spain, their economy is largely driven by tourism and consumption as a result of more household income, people going on trips more frequently. Spain's economy has seen significant growth relative to the other countries in Europe. They've also had a lot of investment from the government. Another big area is the divergent monetary policies between the US and the EU. So what do I mean by that? Well, if we think back a couple of years ago, when COVID hit and we started to see a bit of a downturn, the US raised interest rates very quickly. That caused a lot of countries to put their capital in the US, which strengthened the dollar relative to other currencies, such as the euro. Now what's happening is, at least initially, the EU is lowering interest rates, and people anticipate the EU to lower interest rates faster than the US, which is going to have the same effect. It's going to be a flight of capital to the EU, potentially, where the euro would appreciate relative to the dollar. Now, there's a few scenarios there that I'll talk about next, but it's an exciting time to be looking at currency investing. Another issue is risks associated with geopolitical events. So between the EU and China, they're very interdependent, and there's been a lot of uncertainty with EU elections, both at the international level, the EU itself, as well as individual countries. I know the UK isn't part of the EU anymore. Sorry, Hugo. But the UK has had elections, France has had elections, Italy, as well as the EU in total. So there's a lot of uncertainty there with how policies favoring or not favoring China are going to happen going forward. In terms of inflation in the EU is relatively stable and it seems to be under control. So the anticipation there is that the European Central Bank is going to continue to cut interest rates through 2025, kind of with it stabilizing around 2.5% inflation in 2025. And then if we look at the labor markets, unemployment's almost at 20-year lows. So things are looking positive there as well. So then how does this affect your investment portfolio? That's kind of the key takeaways, right? So if we look at currency, looking at the euro, this is kind of an uncertain time. There's a couple of scenarios where the euro could appreciate relative to the dollar, or the dollar could appreciate more relative to the euro. So two options we could look at. Scenario one, the dollar remains strong. EU growth is slower than anticipated. Perhaps energy prices increase again. And, the EU Central Bank is slower to cut rates. So that could keep the dollar strong relative to the euro for the next couple of years. A different scenario is interest rates continue to fall. There's high growth in the EU, and it attracts more capital from the US and other countries, which makes the euro stronger relative to other currencies. Real estate. So what's happening to your real estate if you're planning to buy or you currently own a property? Well, typically what happens when interest rates go down is real estate prices go up. Money becomes cheaper, you can leverage your portfolio more, mortgages become more available and at lower prices. So that tends to increase real estate prices. Looking at your portfolio, asset allocation, When growth happens, which is what we're experiencing now in the EU, stock prices tend to go up. There tends to be more capital flowing towards equities versus fixed income. And as interest rates are going down, interest rates have an inverse relationship with bond prices, existing bond prices. So bond prices should go up, and new issued bonds, the interest rates should be lower. And then just kind of generally speaking, what's going on in terms of regimes in the EU. There's lots of different favorable expat tax regimes. In Spain, there's one that's colloquially called the Beckham Law, which means you have a flat tax, much lower than the progressive tax rates. There was one in Portugal a few years ago. Italy has one, Greece. A lot of countries have them, but they tend to be disappearing. So that's something to keep in mind. If you're planning on a move over to the EU, you might want to look at specific countries, more favorable tax regimes, and what's going on there. And that's, I would say, a similar situation with golden visa programs. The EU is trying to crack down on some of those for various reasons, and they tend to be becoming more capital intensive to get one, or in general decreasing. So now getting into some of the more nuanced details here. This chart is looking at the euro to the US dollar. So if we look at the euro is set to appreciate, according to our friends at Standard & Poor's, relative to the US dollar during the next 2 years. So again, this has to do with demand for the currencies, as well as what's happening and anticipated to happen with the central banks, the Fed in the US and the European Central Bank. And we think that, historically, if you look at this purple line, you can see the exchange rate between the dollar and the euro. So historically, we're saying, we're more in the 120 range. I'd say it's about the mean. Currently, we're closer to 110, and that is anticipated to increase more towards normalcy in the next couple of years. And kind of the reasons for this, as I said, are stronger economy in the EU, the ECB potentially cutting rates faster than the US. There's still some political uncertainty, with what's going on over here, but this could be an important factor I wanted to highlight if you are planning to purchase a house or do a large currency transfer. This is something you might want to speak with a currency broker about, or really do some research on what's going to happen with the euro in the next couple of years. So this one's looking at inflation, which was in the EU largely driven by energy prices. Lower energy prices means economies tend to perform better. They have increased manufacturing, all prices go down, so households at the consumer level have more money to spend. So there's been a rebound in construction, a lot of increase in trade relative to lower energy prices. This has caused inflation to recede and lending rates to fall, which has also increased kind of changing business cycles. And consumer business and investor confidence has also recovered. Okay, this chart is looking at unemployment rates. So if you look at the far left, this is the Eurozone as a total. Then we have Germany, France, Italy, Spain, and the Netherlands. And the line is the minimum and maximum range over the previous 20 years. So you can see this is last month's reading. We're pretty close to all-time lows there in terms of unemployment rates, which is pretty promising going forward for how the economies are going to perform. So this slide's looking at how households have been impacted by energy prices and how we think going forward, having more money is going to increase their purchasing power. So if we look at GDP, what drives GDP? There's kind of 4 categories: consumption, investment, savings, and government spending. So here, this is looking at if we have more money, that's going to increase consumption, which should lead to increased growth in the EU over the next period. And analysts think that as energy prices continue to go down, both at the consumer level and the business level, that should increase consumption as well as investment. So it's another positive indicator looking at that, but also then the unemployment side. nearing full employment should be another promising indicator for future rate cuts as well and continued growth in the EU. So this is looking at real GDP growth. So there's real GDP and nominal GDP. The difference is real GDP takes out inflation. So this is how do the economies actually grow when we take out things like energy costs and various other factors. And on the far left is the Eurozone. The first block in teal, I believe, is Q3 2023. The yellow block is Q4. And then the purple is Q1 2024. So you can see quite a nice increase from around 0 to -% in Q1 to Q2, or Q1, sorry, being quite positive, just under 0.4% in the EU as a whole. And then leading the way, sorry about that, leading the way is Spain over here on the far right. So you can see quite a nice economic performance there. Germany has kind of struggled. They're more manufacturing, more, again, impacted by energy prices. They have kind of a more robust economy than some of the other countries like Italy and Spain do, France as well. So we expect to see Germany rebound as energy prices have continued to fall as well. And then Spain's growth has been largely driven by increase in tourism, expansion in industrial production, savings both at the consumer level and business level in energy costs. And Spain has also done something interesting. They've had a lot of government investment during the past 3 or 4 quarters, which a lot of the other EU countries haven't. And you can see that's been quite present in the GDP growth. So here we're looking forward-looking wage tracker. The compensation employees will decelerate slowly. So what does that mean? So what we're looking at here is inflation trends. So what's expected to happen in the future? So currently inflation is around 2.4% as of April, and it peaked at 10.6%. So you can see by keeping interest rates high, the European Central Bank has done a good job combating inflation. It's come down. And then looking at what are the components that have come down. So there's kind of the base effect of inflation, which in this case was energy and food primarily. This could be due to, the war in Ukraine that impacted a lot of food prices and getting cut off from energy prices from Russia that impacted that. And then what's the second forward-looking component is wages. So how does this affect wages going forward? Wages are sticky, they call in economics. So they're slow to respond versus some of these other factors. So that's a concern for the European Central Bank, is that wages could continue to creep up, which might mean we might have to increase interest rates in the future. And that's a concern for what's going to happen with growth as well. So that's something to keep an eye on. Long-term inflation, we expect to hover around 2.5% until around mid-2025. That's kind of a good indication there. I know I'm running a bit long here. This one, so the ECB looking at cutting rates relative to the labor market. So reviewing the data is what the ECB wants to continue to do. They want to be cautious, but they are planning on 5 additional rate cuts through 2025, which will bring rates down to kind of a normal level. And lastly, here is Eurozone exposure to Chinese demand has increased across the board. If we look at the yellow, that's 2010. So the categories here are all the sectors of the economy, from electronics down to basic pharmaceuticals, chemicals, basic metals, all the big sectors, 2010 versus 2019. So you can see demand has basically doubled. So the point of this is the economies are very interwoven. So if trade relations with China drastically decrease, again, this could lead to prolonged inflation, which could also lead to slower rate cuts from the central bank, decreasing growth, which could impact your portfolio and stock prices. So something to look at is how the new government in the EU responds to relations with China. If there's going to be further tariffs, recently there was a tariff placed on Chinese electric vehicles. China responded as you'd expect, with their own kind of backlash. So that's something to keep in mind as we look at the new government and how relations between the two develop. So with that, I will pass it back to Hugo for questions.
Thank you very much, both of you, for those great presentations. We just have a couple of questions that some people have sent in for you to answer. So the first one is, which sectors will perform well if inflation continues unabated?
Yeah, so I can kind of take that one maybe, and let's look at, let me share my screen with you here, actually, if I can still do that. Got a little chart here. Okay, can you see that? There we go. So these are kind of three charts actually. At the bottom is actual inflation. So this is from 2021 to the end of 23, which is kind of where inflation went up. We're looking at the US stats here. And so when you look at this, inflation went from here, we were at 1% and all the way up to about 9% in the middle of 22. And now we're at about just over 3% in the US. And so what's done well? Well, not much, but there's two things to look at. First of all, inflation going up, and then you have this middle one is interest rates going up, the Fed rate in Europe. So it kind of lags inflation going up, right? The Federal Reserve lags it a bit, raising interest rates. So there's two aspects to this: interest rates going up and inflation. And so when we look at various asset classes, so we look at the stock market, the S&P 500, which is the purple line. Well, as you can see, in the initial part of the inflation thing, we still had pretty good stock market returns. But then once inflation got really high, the stock market started going down, and especially once interest rates started going up, it started going down. And the blue line is gold. And so gold is, for example, it kind of puddled along as inflation was going up. A lot of people think gold as an inflation hedge. Well, not so much. It kind of went sideways, and then it actually went down. And in fact, everything went down. We're looking at bonds here as well. We're looking at emerging markets. Once inflation got really high, interest rates started going up, everything kind of went down. It's certainly not good for bonds. But then once things stabilized and maybe interest rates were still going up and we saw inflation going down, there was a general pickup, and actually gold did pretty well. The stock market did well because of the technology shares in it. Emerging markets and bonds, though, still have not recovered. So the answer to the question really is it depends on how bad inflation gets, how quickly it increases, more the rate of increase, and also on what interest rates are going. But if we get what we had before, inflation getting really high again, I think we're going to see the same thing. There's going to be nowhere to hide. Maybe gold. And so you need to bear that in mind and adjust your, maybe you need to lock some money into bonds. You can now get 5%. And if you want to lock that money into bonds, not bond funds, but actual bonds, that might be the way to go. At least you get a 5% yield and you can hold them to maturity and that kind of thing, and maybe higher yields in corporate bonds. So yeah, inflation is the killer, and stagflation is especially the killer if we have low growth and inflation at the same time.
Thanks, Tom. Question, I think, for Shane. Somebody said, I live in Italy and my US broker doesn't want to deal with me anymore. What should I do?
That's a good question. We hear that one a lot, actually. So we work with primarily two different custodians or brokers, Charles Schwab and Interactive Brokers. Charles Schwab, every September, publishes a list of the countries that they work with in the EU. And that generally doesn't change, but from time to time it does change. Recently, they removed Italy from their list. So maybe people have worked with Charles Schwab in Italy before, and now they can no longer do that, in the sense that there's kind of three categories. You can maintain an account, you can't open a new account, or if you move to Italy and you have an existing account, you can keep it. So Italy currently is off Schwab's radar. You can no longer open an account once you move there. So that kind of leaves you with Interactive Brokers. Now, what are the nuances of that? Well, if you work with interactive brokers, what can you hold in your account? How can you invest your money is the question. If it's a taxable account, you can't hold mutual funds. Those have to be regulated in the country or jurisdiction that they're offered in, which they're not, being US mutual funds in the EU. And you can't hold US exchange traded funds because of a regulation called PRIPS, Packaged Retail Insurance and Investment Products. That's an EU regulation that says if funds are being offered in the EU, they need to have this fact sheet, which is called a KID statement, and US funds don't produce that. Now, there's a bit of a workaround in other countries if you work with Charles Schwab. With Schwab, they take the stance that if you work with a US-based registered investment advisor, like I am, for example, then the burden falls on the advisor, which is based in the US, so you can buy the exchange traded funds. So focusing back on the question, if you're in Italy, you have to use an all stock portfolio, for example, on the equity side. And then on the fixed income side, individual bonds, maybe, interest bearing stocks as well, preferred shares. But it's more complicated. You need to really invest some time on that. And that's something that we focus on in our firm. We have an individual stock portfolio for countries like Italy or Spain, where it's difficult to find products for US people.
Well, thank you very much to both of our expert panelists, Tom and Shane, for taking the time to join us today. If you would like to schedule a consultation with either Tom or Shane to discuss your personal financial planning or investments, go to EuroUSAFA.com or IAMadvisors.com. Our next quarterly markets update and economic outlook webinar will be in October, when we'll look at the possible outcomes of the US presidential election in more detail and possible financial opportunities that may arise from those outcomes. Thank you all very much for joining us, and have a great rest of your day.